Okay, everyone, this is Sarah again with Student Chapters. I will turn it over to Carrie Slattery, who will take you through the PowerPoint.
Okay, thank you. And this is our, notice we have quite a few participants from yesterday's webinar on today's webinar. This will be a different format since I'll get to go back to my professor mode and do most of the talking today instead of answering questions, even though we will. You can ask questions. I'm getting a lot of feedback on my phone. The people need to hit *6 to mute their phones. That's better now. You know, since I'm using my screen today, I can't see questions come up in the chat box. So if somebody, you know, if you want to ask a question, you'll have to ask it verbally, or if somebody isn't logged in that way, if somebody can tell me if there's a pertinent question that I should address that pops up while we're going through this. So anyway, this is a third year we've offered the financial analysis tool for students to use for the problem, and we think that this year will be especially helpful because of the way you have to come up with your own offer price this year. So I will go through that as we get into the webinar. So you know, everybody should, if you've seen this, it's posted with the everything else about the problem statement. It's an Excel file. You know, it's here to help for your university teams complete their financial analysis. So you know, what we did is set up a fairly simple process to guide you through the data entry. There's about 9 or 10 forms that ask you for, you know, the information you need to come up with to do your financial analysis. And when you're done, you hit analyze, and it'll do all your cash flow projections through the life of the project and give you this rate of return that you know, you need to make sure that matches the targets for the project. So after you've gone through this once and entered all the data in, you can easily go back and just change any one of those numbers. You can actually enter it in the Excel spreadsheet, or you can jump, you know, immediately to one of the forms where that entry was done originally, and set that up. So I'll show that real quickly at the end. But again, you know, we tried to make this very user-friendly. So we use a simplified model here. You know, there's some commercial programs out there that will allow you a whole lot more flexibility. You know, say you're selling more homes in the winter and fewer homes in the summer and all that. You know, we tried to, you guys have enough other things to worry about to get this problem done. You'll get a very good answer with the simplified model instead of spending, you know, a lot more time with a very complicated, you know, software package. So we think this still gives a very good answer, and you know, it's appropriate for the level that most of you are at. So you're not required to use this. You know, some teams do their own spreadsheet. I think though, for, you know, if you're trying to come up with this offer price, and I'll talk about how you will come up with that, you're probably gonna have to have some kind of spreadsheet set up to make this work. So I think this, if you work with this tool a little bit, it should help you out. If you have questions about this, again, I'm, you know, always open to questions, even suggestions, you know, ways I can improve it for next year. You know, go through the Google group. I believe I have the link right here. You know, I get an email as soon as somebody posts something there, and I've been trying to keep up with those pretty quickly this year. So we're going to, you know, look at just example inputs. These are the same examples that we have. There's a instructions, you know, another PowerPoint on the NAHB website that goes through this. So you know, it shows inputs in all the different forms and the, you know, completed analysis. You know, they're not in any way related to this year's problem. Obviously, you'll see the dates are from 2 years ago, so it's I haven't changed the example since I first posted this. So obviously, you're going to be coming up with totally different numbers. But, you know, this still give you some guidelines on maybe what would be appropriate for some of your inputs. So again, you know, we tried to simplify this. So, you know, there's assumptions that are hardwired into the program. You know, basically, you're going to have the same number of sales every month. Over a 5-year project, that really won't affect the result very much. You know, if you have, so, you know, again, it's to save you from spending too much time on very minor details. So, you know, just disclaimer here. This thing has worked pretty well. I've never had anybody have any questions or find any bugs, so I'm not sure that means it's no bugs in it or nobody's been using it. So, but, you know, it's up to you. Like any computer program you ever run, you need to make sure that the answers you get out of it are right. And so, you know, check all the results, make sure they make sense, and before you go and present them to your boss. So, you know, the example, basically we're going to go through I've got 9 different forms here, input forms on the project, on the program, and, you know, talk a little bit about how that works and what kind of things are expected on those. So first thing you do is, you know, the financial analysis assistant is available, on the in the materials on the NAHB website. So you have to download that. And it's important, I think, that you download and don't. I think maybe if you just double click on it, it might open up. Try to open up in Google Docs or something. So you need to download it as an Excel. Open it in Excel. As with most Excels, you usually have to enable editing first. So you'll have to do that, and you're probably used to that if you've opened other spreadsheets. But you also have to realize there are macros, little Visual Basic for Applications programs built into this, and that's a way that people transmit viruses. So I can assure you that I haven't put any viruses in here, but you have to enable content. That's another thing will pop up that you say you have to enable content, or else it won't work at all, basically. So those two things you have to do. I think the way Excel works now, once you've got those on your computer and you've enabled it, then the next time you open it, it used to be you had to say it every time you open it, but now once you've opened it once, you're good. Then if you go to the output sheet, and it may be up automatically when you open the spreadsheet, there's a button up in the upper left-hand corner that says Run FAA. So you'll click that, and that'll run through the program. This isn't just a standard spreadsheet where all the formulas in the spreadsheet, because we had to make it flexible enough that everybody could put in different numbers of different project durations and all these kinds of things. So the macro pretty much does most of the calculations. There are some equations in the sheet, but most of them run through this macro. So you'll get this when you hit Run FAA. You'll get this little screen that comes up, and again with my disclaimer on it. Click OK on that. Then you get to the initialize form. So there's three worksheets in the spreadsheet. One is called input, one's called output, and one is called tables. I think you don't really need to worry about the tables, but again, you could change these, use different sheets, but you should just use the default input and output sheets. For right now, this form will come back after we've input everything, and then we'll click the Analyze button. But for right now, we'll just click OK to start doing inputs. Every one of the input forms has this button at the lower right-hand corner called Form List. So if you've already gone through all this, you've got most of your inputs in, and you just want to go change something on your property tax form, you can go here and just jump directly to the property tax form and do that, and then you can go back to Form List there and come right back to your initialized worksheet. So you're not, you don't have to scroll through all these forms every time. So that's our initialize. So basically, first time you'll just click OK there. So now we are going to, you will already, before you get started on this, you'll already have to have done a fair amount of work on the project. Start to, market analysis, start through how many lots, what size lots, all these kind of things that you're going to have on it. But the first input sheet here just asks how many lots you're planning the development. So you'll, you've got the site there. You'll lay out, you'll find out what appropriate lot sizes are based on your market analysis, and you'll come up with some number here. And then a lot of it is based, we're going to offer different models, different types of houses, and most times in a project, each of the, you'll build a model home for each of the individual, housing types you're going to sell. So you'll want to know what that is. There's some guidelines in the desert color community information, but you'll have to decide from your market analysis and all that what number that will be. So those are two inputs. And the next is putting in our land acquisition and improvement cost. So again, the big change this year is we didn't give you a land and acquisition cost. So, but you still have to put a number in here. So, $10 million might be a good place to start. So what we'll say is once you get everything done, then we'll go through and we'll do kind of a guess and check. We'll try different numbers here, see how that affects our IRR, and that and maybe some other information you have of what you think this property should be worth. You'll come up with what that offer price should be. So you'll pick your start date. This year we said it's going to be March of 2020. So that'll be a start date for that. Then we have two other categories here. One is for improvements to the site, and the other for the common areas. So the master developer is going to do all the road network outside of our property, the project site. But once you get into that, you'll be responsible for all the roads, grading, lot improvements, utilities, all those kinds of things. We posted a new kind of update to the site utility. I believe it's posted by now on the website under the important material. So you want to check that out. Just a little bit of clarification on the utility. So anyway, You'll be responsible for all the, again, road network, utilities, all that within the project site. So you come up with a cost for that. Again, after a lot of detailed analysis. And then you'll put down, the range of time, your start date and finish date when you plan to be doing those improvements. So, the way this example was set up, looks like we're going to do all the improvements, put all the road network into the whole project right at the beginning. And in this case, it took about 8 months. A lot of people have asked about phasing, where we'll do some of the, do some of it the first, to start off the project, get our models built, start selling those, and then do more improvements later. I haven't added that. It'd be pretty complicated to add that to the spreadsheet. But if you plan to do improvements, starting, March of 2020 when you close, and you think you'll still be, by phasing, you'll still be doing some of these improvements, a couple of years later. You can check the sensitivity, but if you just took all your improvement costs for the whole project and spread them out over from the time you plan to start to the time you plan to finish, that would be, I think that would be a pretty good estimate. So, again, we don't, again, a more sophisticated program would allow you to break up your improvements into a bunch of different phases, but we, again, try to keep it simple. But, again, if you try that out and change these dates, you can see how sensitive it is to your result is to those range of dates. And I think you'll find it's probably not real sensitive. Now, you also will probably have common areas. We talked yesterday in the webinar about, the Desert Color community has a bunch of common areas, but we expect that, you will probably have common areas just for our active adult community. So these will also be, cost for you to estimate the cost for that and the time over which you plan to construct those. Do you need to have all these amenities in right away to do your marketing? Or are you going to, wait and, not have them all open until you think you sold all the homes? So those are the decisions you have to make there. So we have to do a lot of work to come up with these total costs, and then you input those along with the dates over which you will, incur those costs. Now we're going to look at our individual houses, the products and what those will cost. So in this example, we said we had 3 different products. So you're going to estimate, of all your lots, how many of the, model number 1 do you expect, plan 1 do you expect to sell, how many of plan 2, how many of plan 3. Again, these are just estimates, but hopefully, based on your market analysis. So you want to type in, usually you'll do 1 model for each of the different products, and then the total number of production units. So, what we're saying here is you're planning to sell a total of 20 of whatever plan 1 is. You put a number of square feet for that house. Then you need to estimate your direct construction costs for each house. So that's, labor, materials, and equipment to do that. And again, this should be, as you're working through this whole thing, it should be more than just a square foot cost. You need to, maybe not as detailed as determine how many 2x4s you have to have for each house, but maybe you do it in that level of detail. But it should, definitely reflect the type of houses, the level of finishes in the houses. So you want to come up with a good estimate for the direct construction cost. Then you want to look at what your base price will be for just that baseline model. Again, this is really, some people think, this should be a direct cost for $200,000 and my base price should be double that. But this is what the market will pay for that. So your market analysis tells you how much this type of house, how much you should expect to be able to sell that for. And that would be for, without any options in it, just kind of that base price. So you input that. Then what we call premiums here, what we really are referring to here are things like lot premiums. So this number here, the $10,000, is an average of all the lot premiums on this project. So, some lots will be, favorable locations that will have nice views of the mountains and things like that. So you may charge $30,000 or $40,000 extra for that lot. Other lots right in the middle, nothing too special, might have no premium. So usually what you do here is for the, look at all your lots, look at what premiums you're going to have, and add up the total. So in this example here, we had 120 lots, and I'm saying my average premium for those lots will be $10,000 a piece. So when I added all these up, that comes out to $1.2 million total premiums on my development here. So again, that's the average of all those. And for our analysis here, we just spread those out evenly over all the models. Then we have options. So we said this was a base house, but when people sell houses, everybody wants different upgrades. So you want to estimate what the average options are you plan to sell on each of these models. And it might be different. Plan 1 might be the low-end model, and people there may not be wanting to spend a lot on options. Plan 3 might be a higher-end model, and this might be a larger number. So this is how much additional, things you're going to sell on each of these houses. So then you can scroll through these arrows down at the bottom here, scroll through the different plan numbers and update those numbers for every one of your plans, depending how many you have. We had this little warning box here at the bottom that says lots is not equal to units. So once you get, that's going to be up there automatically because you're going to have zeros in all these boxes. So once you get through all your plans and you decide how many units you plan to sell for each one, the total of those needs to add up to the total number of lots that you entered a couple of forms back. So that's our product data. So again, you're out selecting the types of houses you plan to sell. There's a lot of guidance for that in the desert color requirements, and estimating the cost, estimating how much you can be able to sell those for. Then we have other expenses for selling a house. So we broke these up into two different types of expenses. Some are usually described in terms of the dollars per house that those expenses are. Others are usually expressed as a percentage of the prices. So we've given you, 5 things here that we would expect that you would see in each of those categories. And then we have another blank just for other. So anything else that, any other direct expenses you see with the house, you would put in the other block depending on which is the most appropriate way to do that. So closing costs for the seller are usually, pretty standard for each individual lot. Then we have, depending how you do your sales, here we have a percentage of commissions for each of the houses based on the sales price. Again, that depends, if you're paying for buyer's agents, how you compensate your agents. People do that differently, and that's up to you and how you plan your project. Buyer incentive, so we have our base price, but sometimes we have to give a little discount for that. People don't usually want to change their base price once it's been set. So we put some incentives in there, and that is some percentage. Again, an estimate of what you think this market's going to bear. Usually, the builder offers a warranty, and usually that's for 12 months after the house closes. So you want to have an allowance for how much it's going to cost. Go back and fix little things in each house that come up over the first 12 months. This options cost block, on the previous slide, we mentioned. We were expecting to sell $20,000 worth of options on average for each of these houses. This is what we estimate our direct cost will be of that. So, if we sold $20,000 in options, we expect it to cost us 75% of that, or $15,000 for each house to do that. So, that 75% may be high, low. Again, you determine what you think that should be. Then there's any other direct expenses that as a builder we're putting into these houses that are expressed as a percentage of sales price. You can lump that into this last block here. We have another form for other additions. The main one we talk about here is, again, depending how builders account for this, but typically when they go in and build these model homes, so you're going to be building 3 or 4 or 5 or 6 of these on this project. Usually in the model home, builders go in and put a lot of the, upgrades, a lot of bells and whistles in there, so their customers can see what, crown molding and, hardwood floors and all the things going to look like in the house. So, so a lot of times, they spend a lot on these models, and they have to sell these models when you're getting ready to close out your project. And a lot of times, you may not be able to recoup all the costs for all those upgrades when you finally sell these models. So you look at that as a sales cost. So you look at, all the models you're doing, you kind of get an idea of how much you're putting in to put all these upgrades in, and how much you think you'll recoup from that, and lump that in there. So that, again, it gets spread out over all the houses kind of as a sales cost. And then here we have, don't always use this block, but just other sales revenue that would might come up here. While you own this property, you usually pay property taxes on it until you sell all these lots. So that's an expense that goes on in the project. So usually that's once a year you make a property tax payment, and you can just put in the schedule of those payments here based on what the due date is and the year that would be due. So, look over, we told you it's supposed to be a 5-year project, so you'll probably expect to have 5 tax payments, and just figure out what those should be, and here's where you input those things. Okay, now we get into the sales schedule. So again, as part of the problem statement this year, we said our plan is we're planning to be able to complete this project, close it all out in 5 years. So that's kind of been given to you, your sales finish date. But a few other things that we want to input here. First of all is if you look at whether you actually have pre-sales. If pre-sales are appropriate in this market, meaning that, we're getting ready, we're broken ground, we're out there starting to put in lots, but we're not ready to build houses just yet. So we want to get people to order some houses that will be started when we can, first start getting building permits, first start putting housing, which may be, 6, 7, 10, 12 months from now. So look at that, try to determine what, how many of the lots you expect to sell ahead of time. A couple years ago, students were under the impression that when they did a pre-sales, people paid for the house up front. That's not true. They may pay a couple $1,000s in earnest money, but it's sale, the transaction, the money doesn't come in until far in the future. But people like this, they get to reserve the lot they want, all those kind of things ahead of time. So that's an option you can look at. You put in here when you're going to start building your models. So you have to get in there and put some infrastructure in first. But a few months after we start, we'll start building models. And then once those, around the time those are complete would be the date that we plan to start our sales. Then our sales should be finished at the end of our 5-year project life, which is what we're planning for. So those are dates you'll input. Something I mentioned, it's in the instructions, the PowerPoint that's online. But when we put in a start date, we assume that start date is the first day of that month. So this will be July 1st of 2018. A finish date we assume is the last day of that month. So this will be January 31st of 2021. Minor point, but you may wonder about that. Put in the months it takes to build a house. So 4 months might be optimistic, but you got to look at kind of what's going on in that market with the labor available and resource available, and the complexity of the house you're building. And then, depending on how many pre-sales you have, the idea is you're going to start these pre-sale homes, the first, as soon as you can start getting building permits, start putting them up. But your resources may be limited. If you had 100 pre-sales, you probably couldn't start 100 homes all in the very first month. So that's why we just, if you expect to have a lot of pre-sales, but you're going to have to, phase those in over the first few months, you can put a maximum starts per month in here. Now we have our project expenses. So 4 big categories and, pretty major expenses. So we're going to put in the monthly amount for each of these, start and finish dates when it's appropriate. Again, these are all, straight line, exact same amount every month. So with our simplified model, as you put these numbers in, we give you the totals over here on the right side, so you know. So other sales costs. So we talked about, sales commissions. So that may be taken care of in a different block. But all of our marketing, our full-time sales staff, they may be salaried, whatever, depending how you signage, things like that. So it's all part of your plan. You determine what that number is going to be. Marketing and advertising. Same thing, what we expect to spend, average per month over the life of our project. Salaries, judges often say that pretty much every student competition I've been involved in, that students underestimate the salaried staff they need on site. People like you all, when you graduate, might be looking to go out and work on a project like this. So this is where you get paid under these salaries. So get a good idea of what full-time staff you're going to need to manage the construction of the homes on that site. And those are kind of things will be in there. And then overhead that's what keeps your home office running. So if you plan to be an estimator and work in the home office, this is where your salary is going to come from. So, looking at the size of the project, what overhead, what typical overhead rates are for a large publicly owned company. That's where that number comes in. So all these are input, give start and finish dates, and based on the dates you put in, the number of months that implies, it determines the total. All right, so that's the last input form. Last year, since people were able to go out and take bank loans, we had some inputs for loans, but we've taken that out this year. We've already talked about that. So on every form, we said we have this form list button. So if you don't want to go to whatever usually comes after project expenses, you might want to go back and change something on your sales commissions from before. So you click this form list button, and it will take you back to this. Then you can go to whichever one of these 9 input forms you wanted to work with. So if we just click that at the end of project expense, I believe it automatically will take us back to initialize, and then we get to do our analyze for the project. So the last thing we do is it will take us all the way back to the initialized form. If we've got everything input, we click Analyze, and that's when all the calculations, all the spreadsheet gets updated, and here it will give us our IRR value for our, based on the inputs we gave it. So it's only as good as the inputs you've given it. So a few other things, and I'll just show you a couple of things with the spreadsheet. So we have, in these, a lot of different things get calculated and put into these input, both the input and the output spreadsheets. So take some time to study those. So we, just get an idea of what all information we're putting out. And it's, good to go and change parameters, and sometimes that'll give you a better understanding of where these numbers come from. So, you want to take the time to look at these results and really try to understand how your inputs get translated into the outputs. So, everything that we've input through here is highlighted on the input worksheet. It's highlighted in yellow. So I haven't tested this a lot, but I believe anytime you want, you can go and make the changes directly to the spreadsheet, to the input spreadsheet, and then run the analysis again and get the answer. It won't automatically update the analysis because that's done by the macro, but you can make changes just in the spreadsheet if you like to, with just the yellow highlighted boxes. So again, there's a lot of other calculations, things that are in the input worksheet that may provide useful insights. I know one of the judges in the past, we've looked at the competition. We put emphasis on this IRR value, but some companies are also very interested in how much money you're making per house. So how much money are you making on your cheapest house and how much on your most expensive house. We give you some, initial calculations on that. So you may want to look at the return. There's, a lot of nuance to exactly what those numbers might mean. But anyway, again, take a look at those things and see what you can learn about what you put in. And you'll probably, we didn't put any plots in the spreadsheet, but you'll probably want to create some plots in your Excel document so you can look at your cash flow and things like that. So I had a couple slides here, and I'll run this real quick when we do an example on how you might go about determining your offer price. So, I use the term a guess and check approach to determine that, to see what your appropriate, what offer, how much you can afford to pay for this property and still yield an appropriate return on your investment. And we gave you the target of a 20% IRR value as a minimum. So anytime you do something like this, first step is guess. So you have to guess an offer price. So again, the default value in the program is probably as good as any to guess. I think it starts at $10 million. So then that's the easy part. Then you got to go through all your inputs, make sure they're all right, everything, housing costs, sales costs, all these things. And then when you're done with that, you click Analyze, and it's going to tell you on that initialized form, it's going to give you an IRR. So again, our target is 20%. So if our IRR comes in too low, that means that the price we guessed was too high for us to make that return on our investment. So now we have to go look at, we want to go change that number and see where we come out. So we just ran the analysis, we got our IRR, we found it was too low, so now we're going to go back to this land acquisition improvement form. So click that little form list button I've talked about, go to the land acquisition improvement form, and change that one block. I had $10 million in there, so if my IRR was coming in at just 15%, that means this property's not worth that much to me. So I have to put in a smaller number. And at first, I would have no idea what to tell you. Just guess, $1 million less and see where it goes. Guess and check. Luckily, the software does 99% of the work for you, so this is kind of the easy part. So you do that, put in that new value. You got to go back to the initialized form. So you click form list again, go back to the initialized form, hit Analyze, and see how that $1 million change to your offer price has changed your IRR. And just keep doing that until you get close. So obviously, if your IRR is too high, maybe that just means that you're, really good at planning this out, and you're going to be able to make more than 20% rate of return. But initially, you want to go see what offer price can allow you to show your management that you can hit that IRR value. Somebody asked a question yesterday if you should also go out and look at comparable values, what other similar properties are selling for. And anytime you're going to go present information like this to your management, it doesn't hurt to have additional information. If anything, nothing else, just to make sure that you're not totally out in left field on this. So, having more information and, your management will decide exactly how much it's going to offer. So you just are making recommendations then based on your analysis. So that's our presentation. I'm going to flip over here real quick and see if, now wait. Okay, we have one. So one question that came up while I was doing it was whether we find the webinar after it is complete. Zach's going to answer that. So this has been recorded, and I'll take another 3 or 4, 5 minutes or so to show the, yeah, we'll come back to this when I'm done. So we'll look at just, again, I'm not going to go through the full example, but just show you a few things about the spreadsheet. So this is our, when you open it up, I believe it opens up, when you first download it, opens up to this output sheet. And we said we have this Run FAA button. So that's where we want to get started here. And here's what I told you was our initial screen. Here's our input and output screens. So again, we can, we can just flip through these one at a time, just hitting OK in every one and look at our inputs. Well, we've already studied those in the presentation, so we don't need to go through that again. Let's see what happens when we do our analysis. We can look real quick if I, yeah, okay. So I'm just going to say OK on this. Oh, no, sorry. I meant to say analyze. So let's go back to analyze. So I'm just going to click analyze. So again, the macro goes through, recalculates everything based on whatever your inputs were. And after my first analysis and my first guess on what my property might be worth, I came up 33% IRR. So that means that I can afford to pay more for this property and still meet my goal. So now I want to go back to my form list, go to this land acquisition improvement form. So in this one, I had initially guessed $7 million. So our IRR is higher than we need, so it means we can afford to pay more for the land if we have to. So I'm just going to make it $8 million. And I'll add, just tab out of here. So go back to my form list, initialize again, analyze again. And so now, by increasing my offer price by $1 million, it dropped my IRR down to 28%. So, okay, so maybe that was too small of a step. Now I'm going to go back again to land acquisition and improvement. Then I'm going to put in that $10 million that I originally had in the example when you pull it up. And go back to my form list, initialize, analyze again. So 10 million, I'm pretty close. So I could sit there and try to get to exactly 20%. Probably not too useful to do that, but this is pretty close. So that's how we can use this spreadsheet to go through a guess and check procedure to work with that, changing our land acquisition offer price to seeing how much we can afford to pay for this and still meet our financial goal. So again, this you can look at this all the information in the spreadsheets here, but this again just shows you all your time from your first month of your project to the last month, all your expenditures, cash flows, your revenue from, takes a while before we start selling houses here, so we start making revenue on houses. When we start, when you look at this, we estimate how many of each model we're going to sell each month. And again, it's just, each of these is the average for whatever that model is. So again, as you study this, you'll probably come to better appreciation for that. This is the input sheet. As I said, everything here that's highlighted in yellow are numbers that we input in the input forms. So, so they're all available here. But this also breaks down, our cost, different, the direct construction costs or option costs, things like that in the, for each of the different models. Talks about what your profit margin is for each model. Because it's just the nature of the way these analyses work out, in a simplified model, because our, typically our profit margin tends to be lower for the less expensive houses, and that may or may not, because for each of these we're assuming the same, we're giving them an equal share of the project expenses. So more sophisticated software might allow you to base these more on the value of the house and not make them all equal. So again, that's a typical result you'll get without a more detailed analysis where, our Plan 1 with our cheapest house has the lowest profit margin, and our Plan 3 has the highest. And judges always joke around and said, then they'll ask the students, well, why don't you just build all Plan 3s then if you make the highest margin on that? So be ready for that question if you show that result. Okay, so that's all I have for my presentation here. We got a little bit of time if anybody has any questions. Again, if something comes up, any bugs in the problem program, please put the question on Google Groups and we'll try to address it.
No, that guy said he would call me tonight, so I think we'll see how that goes and then maybe go see Heather tomorrow if it doesn't go well.
Okay, I don't see any questions. Again, we got Google Groups, and thank everybody for participating. Hope this is helpful, and we'll again see you in Las Vegas. Oh, somebody's typing. Oh, a few people. Okay, got some questions coming in. No, answers. All right. Yeah, there's the recording of the webinar will be available. Zach set up here that he'll get that information out. There's a question about, we're looking to people to submit multiple projections of IRR. As part of your analysis, your risk analysis, yeah, I mean, that would probably be something your management would want to see. But at the end of the day, you still have to recommend a offer price, but you show them what the risks are, and then they will they'll make their official management decision on that. So in the end, recommend one offer price, but then you can expound on what the risks are, and what's optimistic and what's pessimistic.
I think I can hear us.
We can hang up.
Did it end?
Yeah, I think we're done. No more questions, so we'll have fun. Good luck.